Okay, Bollinger Bands. John Bollinger, thank you for these. These are a nice little tool to use. Now, what are Bollinger Bands? Okay, Bollinger Bands are based on a standard deviation. So, in other words, they form a band or a channel around price based on the standard deviation of the price. So as price starts to get more volatile, the bands will expand. As price starts to, the range starts to contract, the bands will contract with price as well. Now you have what an upper band, which is the standard deviation, which runs above price, and you have a lower band which runs below price. And you also have a median or a mean, or however you want to call it, or a middle band, some people call it, but it's just a moving average of price. So you've got an upper standard deviation, a lower standard deviation, and a moving average. So if you were to plot a 20 period Bollinger Band, that's the same as a 20 period moving average with the standard deviation above and below price. So how do we use it in trading? That's all very well, and as usual, dig down, go and dig out some Google stuff if you want to find out more, but let's talk about it from a trading perspective. Now, the idea with Bollinger Bands is that there's a couple of ways of using it. Now, if you're in a range bound market, now let's see if we can go back to the DAX. I've got the DAX up here, German DAX, by the way. It is kind of normalized for cash, but you get the idea. This could be any market. So the theory with Bollinger Bands is that you sell the high band and you buy the low band, but the caveat with that, like all these indicators, is you've got to use it in the right environment, otherwise you're going to get your face ripped clean off doing that. So but if we look at the traditional environment of a range bound market, so here's a nice range bound DAX chugging along, end of 2016, coming to Christmas, everyone's happy. Let's move the drawing pen, let's go a little bit more accurate so we're not clouding the whole screen with color. The idea is that you're selling the upper band, buying the lower band. Selling the upper band, buying the lower band, selling the upper band, buying the lower band. That's the kind of idea, is that the band is keeping a standard deviation for it. And if you've got a mean reverting market, in this case a range bound market, then you're looking to buy the extremes, i.e. a standard deviation where it's starting to push out, and then you're just looking to do that. By the way, you can adjust bands to suit, so you can have a standard deviation of what you like. So most settings people have it on 2. If you have it on 3, obviously you're going to get far fewer touches, because 3 standard deviations becomes much less likely than 2 standard deviations, and so on. I know someone who uses 2.5, someone who uses 2 and a 3. Again, play around with it, but let's just leave it on 2 now for example's sake. So the idea is that you're looking to buy and sell as the price moves out standard deviation. Now obviously one thing is here, and as a perfect example, as we come into this breakout scenario here, coming to December, pushes to highs, and the price starts to hug the upper Bollinger Band. So this is a case where, just like we looked at the oscillator indicators, you can't kind of just say, hey, it's overbought, I'm selling it. It's touching the upper Bollinger, I'm selling it. Because look, if you went short on the upper Bollinger here with no specific risk parameters, it didn't touch the lower Bollinger until way up here, and that is just purely unacceptable from a trading perspective. So you've got to put it in, again, stacking your layers of edge and understanding. So let's say it's broken out now and it's hugging the upper Bollinger Band. That's one way of showing that supply demand imbalance is seriously shifting in one direction. So what you would look to do in that scenario is you're looking to buy the first pullback to the mean, and the mean being the moving average that you've got running up in the middle of those two Bollinger Bands. And look how volatility expands here. Obviously the bands expand with the volatility, because the standard deviation is going to be symmetrical, and it's going to expand as the movement of the price expands. So you're going to get that expansion, and then you see the bands contract, price starts to go into shallow range again, mean starts to push back up and tags the price, and that's where traditionally you would take your trade. If the price has been hugging the upper band or the lower band, as the mean then pushes back up to the price, you would then take the long for the subsequent move to highs. Again, this is not the perfect example, but my point about cherry picking is we're not interested in cherry picking. So that's how you would use it. And the other way, of course, is as the simile we used with the RSI and with stochastics. You've got your overbought, oversold conditions. If you have a continually overbought condition, so in other words, if price is constantly in the upper channel, i.e. between the mean and the upper band, you're buying the first touch of the lower band. I don't think we quite tagged it here, but you kind of get the idea. The point is you gauge the momentum and looking to buy price. Now, one thing that is very good with Bollinger Bands, again, this is my favorite kind of thing, is filtering. do not get involved if you're do not buy when price is outside or touching the upper Bollinger Band. Look how much that saves you. Even this uptrend, where ultimately an uptrend you're kind of forgiven a little bit for buying, and you get away with it a bit more because price tends to push higher. So if your mistakes of chasing tend to be shrugged over a little bit. But if you just don't buy when you're in the upper Bollinger, touching the upper Bollinger, it's going to save you from chasing things. And even this extreme move here, it just saves you, and this allows the price to unwind a little bit. Just relax, just reduce that spring compression, and then go again. So it's a really good filter way of filtering your trade. Now, if you move to say a 1 minute chart, exactly the same thing, guys. As the market opens, you get a pullback to the mean, the continued lower, hugging the lower channel, and then it kind of gets in the range again. So it's lower bolly, upper bolly, lower bolly, upper bolly, breaks out, hugs the high Bollinger, comes back, tags the mean. There's your trade for the pushback and touching the high Bollinger. Very quiet here, admittedly, but that's kind of the idea. And the other way that people use it on a daily chart is they use the actual width of the Bollinger Bands. So as the Bollinger Bands are contracting, I'm going to stick with the DAX, I'm not going to push it on to anything else. As the Bollinger Bands are contracting, so let's imagine this is a value, so the difference between the high and the low is a value, and they plot that as a line, and actually is an indicator you can use called Bollinger Band width, but it's ultimately it's a derivative from Bollinger's. As it kind of contracts and gets lower and lower, the idea is that because volatility runs in cycles, you're going to get a cycle that shifts, and this thing's going to explode. Now, again, it's not directional, you don't know which way it's going to go, but if you can stack layers of edge onto that and say, okay, well, I'm going to trade a breakout here. Bollinger Bands are tightening right up at this point. They've been the lowest they have been for a while. Then all of a sudden they start to expand. Then you're looking to follow that momentum to the upside. So while you may not want to chase because of the rule of buying on the upper Bollinger Band, you might well say, okay, well, I'll use like a 5-period moving average or something that going to help me a little bit get on board it without chasing too aggressively. But that's one way of looking at the width of the band itself, as well as the price touching the high or low of the band.